There's not enough cash flow for residential to retire on. That's the harsh reality. If you go out and buy a 5% gross yielding property, by the time you pay your maintenance, your insurance, your property management, all the other stuff involved in owning a property, you're not left with enough cash flow. You're better off sitting in a term deposit. Of course, you get growth long term, and that's what you're there for, but you're not going to get the income, and that's what you need if you want to retire.
Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair. And today we've got Scott O'Neill, CEO and founder of Rethink Group Australia, here to talk about Australian commercial property versus New Zealand commercial property.
Crikey, we're back in your life to talk about Australian versus New Zealand property. Scott, g'day, mate. Welcome back to the poddy.
Oh, you're speaking my language.
Mate, I rose between two Australian thorns here.
How good. I've been waiting 250, 300 episodes to address the Aussies. So today, Australian property versus commercial property. Part of this will be talking to Scott, your audience, to pretty much break down that there's some deals across the ditch.
Yeah, exactly. Like this is big part of the research we've been doing. Like, what is the differences? Because there's quite large ones. The places feel quite similar in terms of like the investment landscape, but like when it comes to taxes and lending, like there are differences you got to get your head around. And there's a treaty between the two countries. We allow each other to invest in our own backyards a lot easier than others. So it's definitely worth considering for anyone that has got a bit of experience behind them.
Yeah, and why are you thinking about New Zealand at the moment?
Look, it's purely because of the opportunity. So I'm an investor first and foremost, business owner second. I have looked at this place myself. I'm personally looking to buy here. Already been talking to the banks, and I'm excited to invest because there is an opportunity that right now it feels a bit better than Australia, and it's due to your interest rate cycle and where the market's priced currently. I was first looked at your market heavily in 2021, and back then the interest rates were lower, the prices were much higher, and the yields were lower because everyone was just going too hard. There was the fear of missing out happening there, and I don't invest in those markets. But now you've had price corrections, interest rates are coming down very quickly. Like hearing some of the predictions, it's staggering how much they're predicting the rate cuts and the speed and the amount of them coming up. So it almost feels like 2020 all over again. In like that's kind of the analogy to where everyone was kind of spooked where COVID first hit, and then when they realized the world wasn't over, then investing became a priority and the prices went through the roof. And I'm not saying the exact same thing's going to happen in NZ, but we are definitely going to see upside. Genuine 2025 is going to be a good year. I'd bet the house on it.
Cool.
How good. Okay, first one is just probably on like the maturity of the market. Australia versus New Zealand. How do you feel like Kiwis are in terms of, competition, looking at deals, those sort of things, where we're at, where we think about commercial property compared to Australia?
Yeah, look, it's definitely not at the forefront. Like it's going back 10 years to where Australia was. Like back then, everyone was mostly focused on residential property. There was very limited education. Like we're the first commercial buyers agency here in NZ, and there's a few in Australia. Like there's a lot more education there. It's basically a mainstream asset class there now. It's not mainstream here. I believe it will slightly get towards that because mathematically it has to. There's not enough cash flow for residential to retire on. That's the harsh reality. If you go out and buy a 5% gross yielding property, by the time you pay your maintenance, your insurance, your property management, all the other stuff involved in owning a property, you're not left with enough cash flow. You're better off sitting in a term deposit. Of course, you get growth long term, and that's what you're there for, but you're not going to get the income, and that's what you need if you want to retire, unless you want to just refinance and live off cash that way. But commercial is really high yielding in NZ. There's great yields out here. You're still going to get similar growth rates. So the opportunity for those early entrants into this market is going to be significant. You just got to know what to invest in and how, and avoid the risky markets, because most of us default to reading the newspapers about the CBD office market. Once you start looking into this asset class, you realize there's a lot more to commercial than just that small segment of that small asset class.
Yeah, so obviously interest rates is one that's in New Zealand's favour at the moment. In terms of capital gains and yields, how do they, I know it's kind of case by case, but how does it compare generally Australia versus New Zealand?
So over the last, we got data from 1995 to 2023 for Australia. Most asset classes in Australia have grown around 5.5% to 6% per annum compound rate growth rate. So very good numbers. And it's a similar figure, but we only could go back to 2005 in New Zealand because the data was didn't go further, not reliable data at least. So similar growth rates, which is quite similar to residential. We probably saw maybe 0.5% to 0.75% better for residential, but the yield is the big difference. You're getting 6-7% net returns instead of 2 to 3% net. And it's probably more like 2 to 2.5% net returns for residential.
That's insane.
So big difference. Your total return for commercial is generally higher across all asset classes.
Let's move to the lending side, Mike, because to be able to, especially if you're an Australian looking to buy in New Zealand, we need some money. So what makes things far more complicated, right? If you think about layers of complexity, first you get maybe a resi property, then you learn about commercial. Hypothetically, you're talking about Australians buying commercial property, then another country, which is a whole nother layer of what the hell is going on. How does it work for our Aussie friends?
Yeah, to be honest, the lending is actually quite similar between the two countries. No surprise that the four big banks over here are basically the same as the major banks in Australia, with one exception. So it is actually quite similar. You're looking for a fairly similar deposit requirement in New Zealand. I think it's a little bit worse. We're usually between 60 and 65% LVR is what we will lend to. So you need the corresponding deposit there. I think that's a little bit worse than in Australia, is it?
Yeah, Australia 65 to 70.
Yeah.
But there are examples in Australia you can go to 80% lending.
Yeah. And in New Zealand, we can, like everything, for the right deal. And this, I think, is the big thing with commercial property. Or commercial investment. The bank look at it, it's much more deal by deal, case by case than a residential investment. Because resi lending, it's 99% the same. It's, four walls, a window, you'll rent it out. It'll be somewhere, in a major city center. There's no need for them to go, I'll extend a little bit further here, take a bit more risk. For the right deal with the right tenant, in the right place in New Zealand, you might be able to go a little bit higher than 65%. In New Zealand, you can go up to 100% lending on a commercial property if it is owner occupied. So that just gives you an idea of some of the scope of movement that you have for the right deal.
Okay, and interest rate. So Scott, in Australia at the moment, what are we sitting at in terms of interest rates?
Low 6s to low 7s generally at the moment. They do vary again between applicants. Like if you're doing a lease stock loan, it's a little bit more. If you're buying a sketchier property, you get punished there. So look, good clean applicants are sort of low 6s, and it just does vary. And it's trending down, but not as fast as what's happening in NZ.
Yeah. How about New Zealand, Mike?
You're talking mid to low 7s. And we kind of use the residential floating rate as a bit of a guide. And for most banks at the moment, that's about 7.35, 7.25%. And again, before you said a comment where you kind of said New Zealand has the advantage in terms of interest rates. New Zealand has the advantage in terms of where we are in the interest rate cycle, which is the interest rates are all but guaranteed. It's already pretty much priced in that they're going to be cooling really quick. And when interest rates cool really quick, especially in commercial property, your business confidence comes back, demand comes back, and that's when you start to see the really good kind of returns coming off the back of it. And I think that's what you kind of meant when you said we have the advantage of interest rates.
Yeah. All the momentum is heading in the right direction. While when do you think interest rates will start to move in Australia, Scott?
Market's pricing March at the moment, but look, depending on the day, that changes with the data out there. But we're only pricing in like a 0.25% cut, and then maybe depending on who you read, it might be 1 or 2 or 3 more the entire year. But you guys are kind of doing that in one go because 0.5 to 0.75% rate cut in 1 month. That's what that could be all we get all year. Yeah, depending on what happens with the data.
And you've got in Australia, you've got that their housing market hasn't had the huge correction that we've had. Yep. So your central bank will be a little bit more cautious than the New Zealand central bank about cutting too quickly.
Yeah. Okay. In terms of the deposit, Mike, for Australians looking to buy New Zealand. So getting the loan on the balance makes sense.
Yep.
Do they have to bring cash here? Do they borrow against their home in New Zealand, get a loan over in Australia and bring the cash over here? How does that bit work?
So if we're going for Australia's and New Zealand, let's just work off 40% deposit, 60% LVR, with the exception that you might be able to go a little bit higher. But I would prefer people start their thinking there, then start their thinking at the other end. Look, effectively, if you're using equity out of your residential property or your residential property portfolio, and that is located in Australia, you will have to get the loan approved in Australia and then ship the cash over, essentially. When I say ship the cash over, I don't mean literally put it in a bag and post it over. But you
will get arrested.
Yeah. You will have to get that loan approved over there and then transfer the money into New Zealand.
I was thinking this is why Scott wanted to do this in person. You had to get the cash. The property.
That's why we're here.
Because a New Zealand bank can't take a mortgage, or won't take a mortgage, over your property in Australia to use that equity. So you've got to get the Aussie bank, even if it's ANZ Australia, ANZ New Zealand, you've got to get ANZ Australia to approve that loan and then transfer the money over to use it as a deposit.
Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below.
On the tax side, so important point here, none of us are accountants. If you want us to do a full episode on commercial property tax, right, tax in the comments, and then we'll get Matt Harris to do an episode on that topic. Let's hit some of the main points though. Capital gains tax and stamp duty both exist in Australia, don't exist in New Zealand as of now.
Yeah, and I was just going to say this is one of the real big attractive things for us because we're built in knowing that this horrible tax hits you at purchase. And, we've done $10 million deals and, you're nearly paying $500,000 capital, stamp duty rather. It's a lot of cash. So you actually can lend more because if you use that $500,000 and just maximize the purchasing power, then you can acquire more asset base. So it does slow you down. And then capital gains, not that many of our clients ever sell, like very rarely, like we're generally buying that forever asset here, the trophy investment that they pass to their kids, but it's still there, and that actually brings a whole new dynamic to your market where you can flip things a bit easier. You can, the opportunity cost of staying in a deal it's just easy to get in and out if you need to.
Yeah. So I mean, some of those costs are definitely those taxes they are worth thinking about if you're investing in New Zealand as a pro. A couple other interesting ones. So in terms of interest deductibility, so that applies in both countries. Important to point that out. Land tax. Scott, you got that in Australia?
We do. Different states have different rules, of course. So one of the reasons I have purchased in 5 different states is to spread the land tax bill out. One of the old school mistakes a lot of investors make is just buying only in one state because the land tax bills, they're actually getting tinkered with a lot by the state government. So there is political risk because, like Victoria is an example, they've just basically made tax change rules and it's killed the cash flow for a lot of deals. So imagine you made an investment based on a certain set of rules and the rules change on you. It's pretty they don't grandfather this stuff out too. So it's a big risk. They nearly brought in a big change to Queensland a couple of years ago where they were going to say, we're going to count every other property you own in every state to our land tax threshold. That would have just blown that market up too, but that didn't get through, thankfully. But it's their different state rules. It's a little bit cowboy, but spread your risk around is one of the other reasons I think NZ should be on your radar.
Yeah.
And
we don't have a land tax.
Thank goodness for that. Let's nobody start talking.
I think the other thing to probably point out there is we don't operate on a state by state, but there is no state by state basis in New Zealand.
North or south? No.
So effectively, you don't have that risk of running into different rules for different regions. Yeah, there might be some council guidelines and things that you have to follow. But yeah, effectively you're operating under a one rule system.
Yeah, the other piece, and this is definitely stretching my tax knowledge, is we're getting asked some questions in the webinar last night around like, can I get the money paid into an Australian bank account instead of a New Zealand bank account? Look, you can move money wherever the hell you want. At the end of the day, there's a tax liability within New Zealand, and then that is then applied as a credit to Australia. Is that your understanding, Scott, between the
Yeah,
three of
look,
us?
there's still two different currencies. There is a currency risk or opportunity there, depending on what's happening.
We haven't pegged to the Australian yet.
Yeah, I think I checked this morning. So it's 90 cents. So 10% difference. It's not massive. Look, it's cheaper here to buy for Australians too. That's the other benefit. Like we are seeing the dollar go further, and yields are better. So back when we were talking about interest rates being about 1% higher, like for a similar asset, it's about 1 to 1.5% better yield here.
Yeah.
So that's the opportunity, because that yield will compress once your rates drop. They're going to start paying more and more because they can.
Yeah.
And that's capital growth for whoever gets in early.
Yeah, and then that's like any asset in terms of like there's a window, right?
Yep.
And you can be the person that goes, rates are too high, I'm going to wait and then get involved. But if you're waiting, everybody else is waiting, and then the opportunity's passed.
Yeah, you got to move before the crowd unless you want the average result. So it's very hard to do it mentally, because you go, the interest rate, it doesn't make sense. And it doesn't quite make sense, but in 6 months you'll be going, well, thank God I bought early, because I got in 10% cheaper. Like no one will know until it happens, but there's an obvious
signs
trend
are there.
Yeah. Awesome. What about just changing up a little bit, natural hazards? So what in Australia, when you think about commercial property, what are some of the main ones you run into?
The main one's flood, obviously, because especially with industrial, think about where you want to build industrial. It's low-lying, flat land. So flood comes up a lot. We have a lot of flood maps that they're actually exaggerating them for future flood events as well. So you've got to be kind of like wary that you don't rule out a deal that actually doesn't flood. So we've got very good insurance tools to check things up like that. You've got floods here, but the big difference, which we've obviously learnt and done a lot of research on, is the MBS rating, the earthquakes. You're on a fault line. We don't even know what a fault line is in Australia. So, but we've got bushfires. There's a lot of areas that are prone to it. So that could cause insurance and financing risks. And when it comes to any hazard, the advice I give your listeners is make sure it doesn't affect whatever the hazard is. It could be flooding, it could be contamination, it could be earthquakes. Make sure it doesn't affect finance or insurance, because if it affects either of those, it'll affect your valuation for a future buyer. If it doesn't, imagine your finance doesn't get affected because it's a minor issue. Then banks don't care, the valuation won't be impacted. But insurance, if that's affected, your insurance premium goes up massively. And that means less cash flow, or the tenant's got to pay more. There's a problem there that's going to have to weed itself out. So, those two, that you just check insurance broker, finance, and you can kind of get around a bit of the risk that way.
Yeah, and for those who heard the acronym MBS, and that's new build standards. So in New Zealand, we had some pretty big earthquakes, and as Scott said, we're on fault lines, and the major centres for those are Wellington and Christchurch. So you will often hear people refer to the MBS rating of the building, and it will need to be above a certain percentage in that region. And that is a little bit of a localized thing as well. Most newly built, or effectively all newly built commercial properties that have been built kind of in the last few years will have an NBS rating that is above standard, and you won't need to worry about it.
Yeah, I was living in Wellington from 2018 to 2020.
Poor thing.
And never saw the sun. But I tell you, it just felt like when you're walking through the city, every second day, another building was closing down because of earthquake risk.
Wow.
And that's just where your due diligence is really important, right?
Yeah.
Yeah. No, and look, I spent a lot of time in Greece, and they've obviously got earthquakes there as well. And never felt one. I kind of wanted just for the experience, not a big one, but yeah, like it's if it's not built correctly, and it's a genuine risk. And there's a lot of value add guys out there, trying to buy below, what is it, 67%, then put reinforcement in it, and then all of a sudden it's not a risk for the bank and insurance, and you can actually increase the value that way. But for the everyday investor, it's best to go a bit more passive.
Coming back to one of the initial points was just like, buying an asset in another country, and for those Australians that are thinking, well, those yields that are higher, where interest rates are heading, that's of interest. What would you say to those people who are thinking about maybe looking at New Zealand as an opportunity?
Oh, look, I think just treat it, and you probably won't like me saying this, like another state of Australia. Like it's, we speak the same language. We're together in terms of like how we think about property. Like Australians and Kiwis, we go to war together, we invest together. It's a very similar thing. It's not like we're investing in Nicaragua or something like that, where we've got no idea about the culture. Or
great opportunities out there, though. I hear.
Could be. It'd be very high yielding.
It's a hostel out there,
Yeah, but like, you know what I mean? There's, it's close to get like 3 hours on a plane for Sydney. I know plenty of people that have invested in residential real estate over the years here. Some have had great experiences, some not so much. But look, knowing the market is key, like anywhere. I had the same challenges trying to tell people I was investing in Perth because, geographically, that's a lot further than Auckland. So, but yeah, look, I'll be personally buying here. I think it's a diversity play. We've got so many clients that are, bought 5+ commercial properties with us. And, because of the political risk or diversification, it just makes sense to, hedge your bets, really. And if the interest rate cycle wasn't here and your yields weren't so good, I'd say don't worry. But, you're an investor. It's like investing in the NASDAQ. If it makes sense, do you really care where the head office is of the companies you're investing in? Probably not.
Yeah. And if you are going, well, this is something I'm interested in, the next logical step is just around education, understanding the opportunities, right? It's about reaching out to Scott and the Rethink team, reaching out to Mike at Lighthouse on the mortgage side to understand the lending piece. And you get that information, then you decide where you go from there. Yeah.
And it's like a chicken and egg situation. Is it finance first? Is it us? I think you start the conversation at the same time. If you get an idea with finance, because this is what I did, and the result of my chat with the finance is find the deal, because you got to get a bit of an idea. Like chat to Mike and you'll actually know roughly what you can invest. If it's $1 or $2 or $3 million, it does change the conversation. And from there, you start looking for the deals, and then you go back to Mike with the finance.
Awesome. Okay, so a lot to think about for Australians and Kiwis in terms of the commercial property space. Make sure to subscribe to our YouTube channel. Have a look on Spotify. A lot of interesting stuff happening on the channel in terms of commercial property. Much love to Partners Life for sponsoring this episode. Scott, thanks for coming all the way from Sydney to come and talk to us. Not as far as Perth, I appreciate, but definitely appreciate you coming over. Next time, let's go and do this in Queenstown. We'll catch you next time.
Cheers.